Hey, Renter Retires, it's Adam Schroeder here with another episode, and I am joined today by Jeff Welgan. He is the Vice President of Investor Lending for Bluprint Home Loans, and we're going to talk about all the exciting things that are going on in the lending world. So, Jeff, thanks for joining me.
Yeah, thanks for having me back, Adam.
Yep, absolutely. So, it's been a while since we had you on, and nothing interesting has happened in the mortgage business, right? Everything is just same as it was whenever we talked a few months ago.
Oh yeah, the roller coaster ride continues. It's been a crazy few years.
Yeah. So tell us about the boring situation we're in right now. Like what's changing? What's looking good for investors?
Yeah,
Is there any good news on the horizon?
great news. I mean, rates are finally starting to come down. I mean, we've been waiting for this, for 3 years, and it's taken a lot longer than we all would have liked, but we're finally in a position where it looks like convincingly mortgage rates are on their way down. We'll see where they go from here. I mean, we just had the Fed announcement last week. This is getting recorded on the 19th of September. We have a long way to go in Q4 of this year, and we'll see what comes out of the next couple of meetings. We have two more, one in October and one in November. But based off of let's call it a consensus, even though it's a very divided Fed right now, it looks like all signs are pointing toward rates continuing to decline slowly going into the tail end of this year, as long as we don't see anything come out of left field. If we start seeing hotter than expected inflation numbers coming out due to tariffs or, like we've been monitoring, if that were to occur, or more importantly, now that the priority of the Fed has shifted, or the emphasis has shifted to the jobs numbers, if we start seeing better than expected jobs numbers coming out here over the next month or so, that potentially could push mortgage rates up again. So we could potentially see a repeat of what occurred last September, where, we had such a lead up of last September to when the Fed finally reversed monetary policy and lowered the Fed funds rate a half a point, that when that event actually occurred, and then we had a series of stronger than expected economic reports that came out after it, we saw rates spike back up. And what's interesting is we saw a glimmer, small repeat of what occurred last September, where, we've watched mortgage rates come down in anticipation of the Fed lowering the Fed funds rate, which occurred again. And then the day that the Fed lowered the Fed funds rate a quarter of a point here last week, mortgage rates moved up a bit. And then the day after, we ended up having a repeat here of where we had a jobs number come out, a initial claims number come out that was slightly hotter than expected. There was less claims than expected. And because of that, we saw rates tick up a little bit. One quick correction. I realized I just said the Fed met last week. I was on vacation last week, so I'm playing a little catch up. This was actually this week. Fed met on Wednesday. And so this has all occurred over here over the last few days where, we've watched rates dip leading up to the Fed funds rate. Then we saw the Fed lower the Fed funds rate a quarter of a point and give guidance that they are planning on lowering the Fed funds rate potentially another quarter of a point at each of the two meetings, as long as nothing changes. So we're in a position where I think we have better days ahead. Mortgage rates are moving down. And then when you really look at the direction that the current administration is heading, and whether, you love the current situation or not, politics aside, as real estate investors, we have to be able to have a conversation about, what is currently occurring and where the opportunities lie. Because it doesn't matter who's running the country, there's always opportunities. And with everything that the current administration is doing, is really trying to lower mortgage rates to unfreeze the housing market, which is, if it goes to plan and everything that they're doing actually comes to fruition here over the next, 6 to 12 months, this should mean some very good days ahead for real estate investors.
Yeah, so is the market already kind of baking in a 0.5% or 50 basis points being removed by the end of the year? Is that what you're saying? They're kind of just, it's baked in, and so if it doesn't happen, we're going to see a big jump? Or what are we looking at potentially happening because like you were talking about, it's not really a consensus among the Fed officials. I think there were like 6 or 7 or something like that people who were saying no, we shouldn't be doing this, and there were like 9 who were saying 8 or 9 who were saying, yeah, we should. And so there was just kind of a mixed bag, and they both came out and spoke, or at least put out statements about it. So if the minority becomes the majority, What do you think could possibly happen in that situation?
Yeah, it's a great question. And to the first part of it, yes, that quarter point was definitely baked in. The other two, I think at this point are more than likely baked in. We may still see mortgage rates drop another quarter point, maybe another half if we're lucky going into the tail end of the year. But I don't think we're going to see rates fall off a cliff unless we start seeing much larger issues with the jobs numbers. I mean, because that is where, again, where the emphasis is now. We start seeing dismal jobs numbers going into the tail end of the year and start seeing larger cracks in the economy, GDP numbers start coming out weaker than expected, or if the inflation numbers start coming out much lower than anticipated, we could see rates drop further. On the other side, though, I think to what you were kind of alluding to here a bit is that the markets may be getting a little bit ahead of themselves right now, where Wall Street has a very rosy, optimistic outlook about the tail end of this year and going into next year. So if any of these things were to come out, hotter than expected or not in congruency or in line with the Fed continuing to lower the Fed funds rate, we may see rates spike the same way we did last year. And we may end up in a similar situation where, we have a moment of time here now where rates are lower and the people that are taking advantage of it, that are refinancing and buying now, maybe locking in at the low points if rates do end up coming up again. And the bottom line is nobody has a crystal ball. Nobody knows exactly where rates are going. And it's best to, strike while the iron's hot, take advantage of it while the rates are low. And if rates do continue to go down next year and we start seeing rates convincingly in the fives again and lower, potentially then, refinancing at that point.
When it comes to the jobs numbers, there's been some pretty big news recently whenever jobs numbers have been readjusted or corrected based on, the past job numbers. And they say, oh, well, it wasn't as good as we thought it was. And they get lowered. Whenever you hear that news, let's just say in a month from now, we hear that the job number that came out, a month or two ago, they adjusted it downward. Does that impact rates at the time, or are they just looking at the ones that are coming out now?
This is a great question. So we have watched this same pattern occur over the last 2.5 years, where last year in 2024, for instance, there were 2 million jobs created. And then at the end of the year, just like we saw this year in March, it got revised down by, 900,000 jobs last year, so that they overestimated by almost half in 2024. It did not get much, publicity back then at all because the emphasis of the Fed and the government was on inflation at the time. Now we've seen that shift, and that's why we're starting to see this in the media now for these current numbers, because when we see the evolution of what's been happening with the way they've been reporting the jobs numbers, this is not anything new. It's just being brought to the forefront here and being prioritized by the Fed as one of the reasons why they're now lowering the Fed funds rate. So in answer to your question, and this has been the problem, and one of the issues why rates have been staying as high as long as they have is because when that initial number comes out, it looks like it's a pretty good number based off of their best estimates. And then when it's getting revised down a month or two later, it's done more quietly. It's not getting it doesn't have the same impact on mortgage rates that it would if those numbers were coming out immediately. And so we saw that in 23, we've seen it in 24. Good news is now the information is starting to come out and it seems like it's more accurate. The problem in my mind is that this has become so politicized that now it's got to the point, again, keeping politics aside, I stay out of politics. You'll never see me step into that space. And I don't care what side of the political spectrum anybody's on, but we, as real estate investors, again, need to be able to have discussions like this and be able to have open conversations to identify where the opportunities are for us. I think now that we are going in the direction of, less guesstimates, hopefully more accurate numbers coming out is what it's looking like, at the initial report that came out here recently, this should be more favorable for mortgage rates going forward. It's a big should, whether or not this continues, we'll see. But as of right now, as these numbers come out, in theory, it should be having a more positive impact on mortgage rates, where in the past, because the emphasis was more on inflation, it it wasn't having that same level of impact as those revisions were occurring.
Hey, investors, in this market, the right financing can make or break your next deal. That's why Rent to Retirement teamed up with Bluprint Home Loans to give you exclusive access to investor-friendly loans. You can get rates in the low fives, fast pre-approvals, flexible DSCR short-term rental and portfolio loans, cash-out refi strategies to help you scale, and more. If you want to close faster, cash flow stronger, and build smarter, connect with the Bluprint Investor team today. Call 888-343-1043 or go to the link in the show notes. Speaking of kind of the mortgage rates bouncing around, I talk with y'all all the time to get rates for pro formas and all of that, and floors just keep bouncing around. One day I'll be talking, it's like, oh, the floor is 5.5, and then the next day it's like, oh, it's 5 7/8, and then wait, we're back down to 5.5. Talk a little bit about where we are. Like you said, it's September 19th, so if you're listening to this in the future, it's probably changed a little bit, but know that the trend is still there. Talk a little bit about, number one, what you mean whenever we say floor, and then kind of where that floor is right now and kind of where rates are sitting.
Yeah, that's a great question. And what you were saying, it's been all over the place. I mean, this has been quite the roller coaster ride. And every time we have a situation like that occurred this week where the Fed lowers the Fed funds rate, or let's say a jobs number comes out better or worse than expected, or anytime that there's a surprise, it usually takes about a week or so for the dust to settle, for us to figure out where the new rate range is going to be. And that's why it's been changing so frequently over the last few years, because we've had, well over a dozen of these shocks to the system, some larger than others, and it's caused some big spikes in mortgage rates. So as of right now, as we're, waiting to see what happens next week, we have a PCE, or inflation number, which is the Fed's favorite measure of inflation, coming out the end of next week. A lot's going to be hinging on that. And then we have jobs numbers coming out the week after, and then we have another Fed meeting in October. So as these reports continue to come out, we'll have more clarity on where that new rate range is going to be for the foreseeable future. But as of right now, so any clients, and it really depends on, what type of property they're buying and what type of incentives are available. So when we're looking at your inventory with rent, RTR inventory, on any of the new builds right now, on the conventional side, using the builder incentives, we're able to buy the rates down to about 4.5% on a 30-year fixed with no prepayment penalty. And that's using about 10% of the incentives. So it'll vary depending on the property, but we can get them as low as 4.5. And then on the DSCR side, there's a 30-year fixed with a 10-year interest-only option. And with those, we're able to get the rates down to 5.5 again now. So we're seeing the floor rate, as you mentioned, really starting to open up, and the lower end of the rate stack open up as we continue to progress into this lower rate environment that we're in. And if, again, what's a big if, this trend continues, we should start seeing the lower end continue to open up, and we may see 4% rates again on some of the new builds, and then the DSCRs maybe even to the high 4s, low 5s again. So that's going to be based off of the new build options. And then any other types of properties that do not have incentives. And this is, a lot of flips in different parts of the country that you guys offer. And then for anybody that's listening, that's buying outside anywhere else throughout the United States, that is not a new build, that doesn't have the builder incentives, you're looking at rates right now, if you're putting about 20 to 25% down on conventional financing, in the mid to high sixes. And then on DSCRs, those are in the similar range on the interest onlys, where they're, ranging, depending on how much you're putting down, anywhere from the mid sixes to even low sevens, depending on the credit score and what the actual DSCR, what that ratio is.
Yeah. And that's astounding to me that we're still in a world where, no points no buy downs or anything. Your DSCR and your conventional rates are right in line with each other. I mean, that's, it hadn't been like that very often. And so it's one of those things, people like, oh, what kind of loan should I get? And I'm like, are you kidding me? You have the ability to put it straight into an entity and it doesn't hit your DTI or anything else. Like, why are you even considering it?
Yeah. Yeah. And it gives you that interest only option too. And it's, it's been really interesting though, to that, what you mentioned. I mean, that spread between DSCR loans and conventional loans was, we were at 60 days ago, 90 days ago, that spread was much wider. It's gotten, very narrow now to where even in some scenarios, the conventional option is starting to look a little better with larger down payments. So it's constantly moving back and forth depending on, where the secondary market is and where the appetite is with the investors on the secondary, all the investment banks on Wall Street. But as of right now, I mean, anybody that can qualify going conventional, really the big difference is going to be it's a principal and interest loan with no prepayment penalty. Where on the DSCR loan, there's prepayment penalty options anywhere from 0 to 5 years, which is going to impact what your final rate is. The longer the prepayment penalty, the lower the rate, and vice versa. And then one of the big added benefits to DSCR loans, other than what you mentioned, is the fact that you can do an interest-only loan that gives you that flexibility of making an interest-only payment or making a principal and interest payment and giving you that flexibility to really manage your cash flow, where on a 30-year fixed principal and interest loan, you have to make that P&I payment. And if you make a partial payment, you're late.
Yeah, I think that's one of the big things. People, whenever I talk with people about the option, I mean, there's definitely some properties that I would not recommend going the interest-only route. I don't even know if there's some properties that you can't do it on. I'd be curious to know that. But it doesn't mean you only pay the principal or only pay the interest.
Mm-hmm.
There's always that option, take your cash flow and dump some principal in, and it will change your payment. Right. And so, it just gives you, like you were just saying, more options out there. So, are there properties that it's just not even an option? Like if you were to buy a $150,000 house, is that just never an option? I'm not saying it's a good idea necessarily, but, is it ever not an option?
It's not necessarily not an option unless, you have a lower credit score potentially that would cause you not to qualify. Or no, I mean, it's available, 1 to 4 units. I can't think of any scenarios really where it would not be an option. Some of the Ohio properties, for instance, because of the Ohio rule that we can't charge a prepayment penalty under 113,000, it becomes a loan amounts of 113,000, which is a state rule for Ohio. It becomes a little more difficult, but they're still available. But yeah, there's no real scenarios I can think of where it's like, you cannot do an interest only on this scenario, but you can on this one. So, and then going back to one of the things that you mentioned too, as far as the approaches for the interest only loan, a lot of people look at it of, I'm only paying interest and I don't really like that option. Well, it gives you, there's two ways that you can best utilize this loan. Is either, the first one is, if your primary objective is to maximize cash flow, then you can make that interest only payment for the entire 10 years, but you're going to end up with the same principal balance that you started with if you just make the interest only payment. On the other side, the way I recommend using it is more of a cash flow management tool where as you start to, buy more real estate, you can make an interest only payment or a principal and interest payment. And what I recommend is get used to making a principal and interest payment. Put more toward principal when you can. You can make a 30-year fixed principal and interest payment every single month. But if you run into a position where as you're buying more real estate, let's say you have a tenant or two that moves out, or you have a couple of large capital expenditures, let's say a heater goes out or an air conditioner, or you need some additional money and you get into a cash crunch, you can make that interest only payment without being late. And it allows you to really manage your cash flow. And you have that as a payment option if you need it, instead of making it the go-to option if you're concerned about, paying down principal and, trying to balance out, the equity position and appreciation versus cash flow management.
Yeah. And this is why it's so important to work with a team who actually understands the industry and actually even has these products. There's a lot of lenders out there who claim to do investment loans, but don't even know what a DSCR loan is. They just mean they'll lend conventionally on an investment property, and then there's other lenders. I mean, y'all have loan products that other lenders don't even have, right? Because you have different investors. Y'all are doing some of the, loans yourselves and securitizing them and doing all of these things that give investors different options out there. So is there any kind of loan can you run through kind of what loans y'all do and what loans you might not do?
Yeah, that's a great question. So we're nationwide. So we lend everywhere, including New York now on the DSCR non-conventional side. On the conventional side, we're everywhere except for New York. So your pre-approval is good in 49 states with us on the conventional side. And then regarding loan programs, so, I've been doing this for 21 years. For anybody that I haven't connected with yet, I've spent the last 10 years building a team dedicated to solving problems for investors and really helping investors succeed. And so with our product mix here, we lend primarily in the 1 to 4 unit space, the residential space, but we do have commercial products. We do ground up, fix and flip, things along those lines as well. But when we're looking at the the residential 1 to 4 unit space, like we're doing primarily with you, we sell loans directly to Fannie, Freddie, and Ginnie for all of the conventional and government primary residence, second home, and investment property options. So for clients that are doing long, mid, or short-term rentals, we have options on that side. And then we now have, I think, 14 different relationships set up on the secondary market for non-conventional financing, like the DSCR loan. There's a business bank statement loan for business owners that allows business owners to continue to write everything off and show very little and pay very little in taxes, but still qualify for financing. We also have an asset qualifier loan where we can look at your total assets instead of looking at your tax returns. So this is a great option for full-time real estate investors or people that just maybe are working part-time or have very little documentable income. And then we also, like I mentioned, we do have more creative solutions. We have a team in the division that handles all of our ground up construction, fix and flip financing for our clients that are doing flips and burrs. We do commercial, where we'll do mixed use commercial, multifamily. So we even do more creative stuff like portfolio lending. We have options for RV parks, storage units, things along those lines. So feel free to reach out. Anybody that's listening in the audience that has any questions on any of this, there's truly no stupid questions. Reach out. If we don't have a product that fits your need, we will definitely have somebody that we can refer you to as well, because we really focus on, again, trying to solve problems for investors. And if it's not something we can help with, we try to provide solid guidance, and we'll link you up with somebody in our network that may be able to help that's a trusted partner.
Yeah, and the link for that will be in the show notes, so everybody can go there and not have to memorize the link that I'm going to spout out here while they're driving or watching on their phones. So, is there anything that we need to touch on, or are you seeing most people? What is the appetite for the real estate investor right now? Are most of them skewed towards DSCR? Are they skewed toward conventional? Is it kind of 50-50? Where are you seeing it now compared to maybe where it was a year ago?
Yeah, that's a great question. So, it just depends. It depends on the investor. It depends on, where they are in their investing journey, because now that conventional rates have come down so significantly, for anybody that's just starting out, it may be worth taking a look at conventional financing, because with that option, it gives you that flexibility of being able to refinance at any point because there's no prepayment penalty. Where on the DSCR side, again, like we talked about, there's options where you're, agreeing to not refinance or sell within some given amount of time. And you just got to take a look when you're running deal analysis to see which one's going to make the most sense. But in answer to your question, we're not really doing more of one or the other at this point. I would say it's probably even maybe 55% conventional, 45% DSCR, where it was the other way earlier this year, because the DSCR rates look so much better than conventional rates did.
Yeah, it's definitely an interesting time to be in the mortgage.
It is, we'll see what the rest of this year brings, but the wild ride continues.
Yeah. Well, Jeff, is there anything else you feel we need to tell the listeners before we wrap it up here today?
Yeah, we've got year end coming, and I always try to get out ahead of this because November and December tends to be very busy times for real estate investors and for us, trying to meet year end purchase deadlines. So anybody that's trying to buy an investment property before the end of the year for tax reasons, my best advice to you is get as far out ahead of this as possible. Every year we have clients that are trying to close that week between Christmas and New Year's, and it always makes it a fun time for us. But, we understand the importance and the need to get these closed by year end in order to meet the deadlines. So looking at a calendar, I was taking a look at this before we jumped on. We've got a pretty tight window this year because of the way that Thanksgiving falls and then Christmas and New Year's. There's not a lot of time there the last couple weeks of December. And so, ideally, if you can get into contract before Thanksgiving, that'll help ensure we don't run into any issues, year-end issues or any delays. Just got to keep in mind title companies, escrow companies, property management companies, appraisers, everybody takes time off during those times. Everything takes 5 times as long as it normally does. And there's just no guarantee the closer that we get to Christmas that we're going to be able to close on time. So if you can get into contract the first few weeks of November, that'll help. Worst case, you're going to want to get in contract, that first week of December to make sure that we're still able to get it wrapped up by the 19th, which is going to be technically the deadline. I mean, there's a couple of business days in there if you look at a calendar around Christmas and New Year's, but everything has to align perfectly in order to close on those days. So I would just, again, best advice, get as far out ahead of this as possible and have a plan in place. I mean, the earlier that you can talk to, us or whoever you're working with to make sure your pre-approval is up to date, you've got a plan in place, exactly, how many properties you want to buy between now and the end of the year to meet your tax objectives. Make sure you're talking to your accountant and your CPA as early as possible. So that way it'll help minimize the year-end holiday stress.
Yeah. And we should remind people that just because you signed doesn't mean you closed. Right. And so if you send something in, if the title company gets something, but they're off for a holiday and they don't get it, or if the notary decides, I'm not going to mail this off today. We've had people who didn't close because they signed on the 29th and the notary just didn't put it in the mail that day. And so it got put in the mail the next day. And so they didn't actually fund until the beginning of this year, 2025. So it ruined some of their 2024 taxes because they pressed it so much. And there really is, I think between Christmas and New Year's, there's only 3 business days or something like that, 2 or 3 business days. So
yeah, I'm glad you brought that up because inevitably there's always 1 or 2 every year that rolls till the first week of January. So just don't be one of them. Get out ahead of it as much as possible to make sure you guys have a great holiday season. So because otherwise it can be a little stressful there trying to make this all work. And then to add one more thing to it from a tax perspective, and you want to confirm this with your tax advisor to make sure you're dotting the I's and crossing the T's. But it's, your properties are supposed to be, from my understanding, at least listed on the market. If it's short-term rental, it's got to be, somebody's got to occupy it, for at least a day or two. So you just want to make sure you're on the correct side of this and, not thinking that you're going to close on the 29th and still be able to meet that minimum requirement per the IRS tax rule.
Yep, absolutely. Well, Jeff, thank you so much for joining us today. Again, Jeff is the Vice President of Investor Lending for Bluprint Home Loans. You can go directly to him on the link in the show notes. You can also schedule a time to talk with the rent-to-retirement rep, and we will introduce you to them after we talk to you about your investing goals. Don't forget you talk to their people about your investing goals because they can talk more on the financing side, because here at Rent-to-Retirement, we're not the mortgage experts. That's why we have people like Bluprint around to help our investors through that. So again, really, really appreciate you joining us. The link is in the show notes. And as always, if you want to find a property to finance with Bluprint, head on over to renttoretirement.com. That's renttoretirement.com. You can see all of our inventory, the Ohio stuff he's talking about, some Texas stuff, some Alabama stuff, some Florida stuff. We're all over the country there at renttoretirement.com. And if you have any questions you want answered in future episodes or any questions you want me to pass along to Jeff, just email podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. Really appreciate the time y'all spent educating yourselves today. Talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.